Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock analysis. With me today is David Blake, CMT, here to discuss what happened last week in the market and what to expect this week. David?
Okay. Well, of course, we had a real bumpy ride again last week. Although the VIX is staying around 20, we are having some pretty wild intraday swings. And last week was no different. We started out on hopes that the government was going to reopen, and we saw a huge rally. Um, the NASDAQ was up 522 points, 2.27%. That's its biggest one-day point gain since May. So investors were happy. They were piling back in. And of course, they bought what they were selling the prior week. They jumped back into the AI-related, the Mag 7 semiconductor stocks. And then after that, we saw a little bit of a rotation out of some of those stocks and more into healthcare and energy stocks on Tuesday. Just a little bit of a rotation where people were starting still a little bit nervous about valuations and some also debt concerns with the big tech companies as they're investing in AI. You don't want to be throwing all their money away in something that may take a little while longer to see the returns in. And we also saw on Tuesday, like I said, we saw a lot of healthcare stocks were higher. And on the Dow, we had Merck and Amgen and Johnson & Johnson. They're all pushing up near new highs. And then on the other side with the NASDAQ, we had weak guidance from one of the high-flying IPOs that we've had recently in CoreWeave. That's the cloud platform company that supports AI. And they had kind of disappointing guidance, and they got hammered. They went down about 15, 16%. And then the quantum computing companies that, the Rigetti Computing, some of those, they came out with earnings that were a little bit off, disappointing too. And they are really high. You think Palantir and some of those are high priced. Some of these quantum computer companies are making $100 million and they're valued at 500 million or higher. They're really overpriced. Then we came back in on Wednesday, and again, that rotation kept going into the energy and health stocks. The Dow actually crossed above 48,000 for the first time ever, set a new record high. We saw selling in the Mag 7, and the NASDAQ, I think, was red for most of that day. It may have ended up just with modest losses, but nothing big. And after the Dow closed above 48,000, then we saw it roll over again. Thursday, we had a down day. Then Friday, we had another down day, but the dip buyers did jump in on Friday after we were down several hundred points, and they brought it back up. And what's causing some of that selling pressure is that we're getting several of the Fed presidents saying that they're not so sure that they want to cut rates in December. Part of that is because they lack the data to know what in the heck's really going on. And that's causing rates to tick higher. The bond market has been moving up to about where it was back in September before we started the first rate cut here a couple of months ago. But you're also seeing yields tick higher globally. And that should be a little bit of a concern to everybody, because the reason for that to be happening is because globally, central banks are worried about a tick higher in inflation. Even Trump over the weekend, I think, took some of the tariffs off on food products. So he knows affordability is a little bit of a problem here for especially the United States. So we'll kind of watch to see how that goes. I noticed today we're having another big sell-off. I saw the yield of 10-year treasury is again hanging out around 4.14, something like that. I think it closed on Friday at 4.15. So that's something to keep an eye on, the fact that all the market players want rates, including the White House, they want rates lower, but they're ticking higher. But Friday, we did see the CME Group Fed Watch, where it was a month ago. They projected a 95% probability of a rate cut in December. And now it's all the way down to about a 40% rate cut. And you're having several Fed presidents coming out and saying that they're worried about inflation and they don't foresee being aggressively cutting rates. And a lot of them are saying they don't think we need to cut rates. So that's something to keep an eye on, because if we do see a tick higher in inflation, the stock market's not going to do much. You can kind of count on that. And I think that's probably one of the problems that we're seeing right now. So at the end of the week, we did see the markets were mixed. The NASDAQ was down for a second straight week, but the Dow Jones S&P 500 were a little bit higher, and they've been higher for 3 of the last 4 weeks. But it's just kind of choppy sideways for right now. Okay, the technical condition of the market last week, it did deteriorate some, but most of the major averages came down and tested support at key moving average levels. We are seeing that break down today. Just looking a little bit ago, we had the Dow, the S&P 500, and the NASDAQ all trading down below the 50-day moving average today. The Russell 2000 has been struggling below that. In fact, it went below the 100-day moving average today. And for most of these, the major ones like the Dow and S&P 500 and NASDAQ, that's the first time we've gone below the 50-day moving average since May. So it's that's a little bit of a problem, and we want to see how it's going. Now, on the positive side, I've been talking about you want to see that the October low may be the line in the sand, and I'm not sure we're going to go much below that. I put several downside targets in the market letter on Friday. I think right now we're looking at, let's see, for the Dow Jones, I think we can see, I'm looking at around 45.5 to 45.6. Right now we're trading at around 46.5. So we probably still have another 1 or 2 more days of good selling pressure in there. The NASDAQ, I had said we'd see 22.2, 22.4. And a little while ago, it was a 22.6. So it's very close to our downside target. It's gone down quicker than the more conservative indexes. And then on the S&P 500, I have 65.50 to 6,600, and it's trading right now around 66.50. So again, it's looking like we probably would go down and test that October low. If you pull up a chart, yeah, we'll pull up the SPY here. That's the S&P 500. Okay, what I'm looking at right here, when I talk about the October low, this is where we saw a trade down there. Again, came down and tested that. That's the 50-day moving average. On Friday here, you can see where the S&P 500 went down below the 50-day. Today, we're below that again. So the battle's being fought right in here. We'll see how this goes. If we see this thing break on the Dow and the NASDAQ and stuff, then we're likely to see a little bit more of a dip. You might want to be aware, though, that if we get down here intraday and it seems to hold, then I would, let me throw something up here real quick. I want to put the 100-day moving up, see where that is. Okay, so here's the 100, and it also is coming right in line with the October lows. A lot of times in technical analysis, when you look at different indicators and different support lines and trend lines and that kind of stuff, when they all seem to converge at a certain area, that's something that you want to pay attention to. And in this case, it just so happens that October low that I've been harping on also is the same place where the 100-day moving average is. So again, that's telling you that's going to kind of provide a double support level for the main index there. So we want to watch that. If that breaks down, okay, then we're probably going to have maybe a 7 to 10% pullback in the market. But I still think if we hold that area, then we've looked at probably maybe a 4 or 5% correction, which is not a big deal. And I think that if it trades sideways there for intraday, you could see the market bounce off of that pretty quickly. So just kind of keep an eye on that. On the other side, we have the Russell 2000. Technicians would like to see the small caps and maybe the semis and the transports kind of lead the market a little bit. Now you can see here on Friday, we came down with the Russell 2000 and it found support at that 100-day moving average. And we bounced back on that Friday afternoon. We had a little bit of a rally, but today we're back down below that. So it did not hold. And also it's below the October low. So that's one of your first signs that, okay, it's, that's going to be a real test for the major indexes. But anyway, the Philadelphia Semiconductor, it's also flirting with the 50-day moving average today. It's kind of struggling to hold on to that. Let's see if it can do it, but it's also staying above the October low. So at this point, I wouldn't be panicking or anything like that, as long as that October low holds for the major averages. So just kind of keep an eye on that. Now, as far as this week coming up, what we're going to look at, nothing really big until Wednesday. We're going to have several big retail companies release earnings, and that will be Walmart, Target, Home Depot, I think is tomorrow. But the big one's going to be NVIDIA, and that's going to also be on Wednesday. I personally would not want to trade NVIDIA's earnings to the long side or the short side, because there's some funny things going on there. If they only have a modest beat, then you might have some analysts coming out and saying, well, okay, the AI spending is starting to slow down. So, that's not good for the stock. And then if you have a big beat, again, you might have some of the analysts coming out and saying that this spending on AI is just getting out of hand, and that could be bad for the stock. So you don't know what they're going to do. And I think it would be wise, instead of trying to play and roll the dice on what NVIDIA's earnings are going to do, just to watch what's going to happen. If they come out with a good report and everybody's happy with it, then maybe if we're down close to the October lows or something like that, report comes out and it looks good, then maybe that could support the tech trade. And we could see a little bit of a rally, especially for the NASDAQ and the NASDAQ 100 off of that. So that's something to keep in mind. We also are going to get some data from the government they've been holding off on. I know that they're going to try to get maybe the CPI and the PPI. I don't know if they'll get the PCE with the personal consumption expenditures out or not. That's the big one that they'd like to see. But we're going to, over the next probably 5 to 10 days, we're going to get the reports out from the federal government that will basically cement what the Federal Reserve is going to do at the December FOMC meeting. So a lot of things that can move this market that's going to keep it trading volatile. It'll also be choppy. As we saw today, I think the Dow was down 250 points early today, came all the way back up to the break-even line. Last time I looked, it was down about 600 points. Again, we're starting to see the AD lines, which we look at as leading indicators of market direction. They're beginning to break down. You can go back here to the home page to where we come down over here to the market recap, market at a glance here. We can take a look in here. You can see how we're starting to flirt with these lines. But then over here on the advanced decline line, you can see this. You can also look at these things almost like a chart. When the AD line is taking out prior lows, that's a bearish signal. That means, again, more stocks are under distribution. Today, here we have the NYSE. It's been holding up a little bit better, but today it's about 2 to 1 to the downside. So you're going to be coming down here again, and we'll see if it can take out the October low on that. That's another thing you can look at. If we're getting up to coming down, it's getting close to the October low, and you see this AD line take this out, that again would be negative divergence and probably telling you that, okay, we may be going back here to maybe July or August. We'll have to see. But I wouldn't be a hero this week. As far as our CTI, we're still negative. We had the call seems to be working out pretty well for us. But very soon, and probably in December, these cycles that we follow coming up here in the next several weeks, you're going to have the A, B, and C cycles all bottom. And when you have three big cycles like that coming down where they're supposed to hit a trial at the same time, that's the 6-week, the 18-week, the 36 weeks. That generally is, especially when the C cycle comes down, you usually have a pretty good noticeable bottom in that thing. As of right now, we're looking at probably another 1, 2, 3, 4, maybe 5 more weeks. If you're following stuff at home, what you want to look at is for the Dow Jones, you want to see it as long as it keeps making a low for the week, and that will extend the bearish cycles out a little bit longer. So that's something you can do at home. Take out your pencil and paper and keep track of that. And like I say, just right now, I would just be very hesitant to really get in here and be trying to buy the dips, because we don't know how much it's going to go. You have a lot of things that say it could go lower, but you also have on the other side, fundamentally, you have a lot of analysts that are starting to raise earnings for the first quarter. We'll have to see. And plus the jobs data coming out that's been delayed, how bad is that going to be when that gets reported? And then once the CPI and PPI start coming out, right now we're going around 3% inflation. If all of a sudden it ticks up to 3 or 3.2, the Federal Reserve isn't going to like that, and they're not going to be in a mood to lower rates. So this is one of these times where, hopefully maybe the last couple of weeks, as we've been telling you, we're bearish on the market. Maybe you've trimmed some positions or closed out your margin accounts and just kind of stood on the sidelines, and let's see where this market's going to take us here over the next couple of weeks, and we can get back into that. One other thing I did want to mention while I got you here, if you go to the ETFs, actually, let's go to the watch list. I have a list of all the different sector ETFs that we follow in MarketEdge. And you hear Jim Cramer talk once in a while about there's always a bull market somewhere. And I run a portfolio of ETFs in here that does quite well. It's not as volatile as the regular market. It doesn't have individual stocks in there. But if you take a look at the different ETFs that are outperforming right now, over the last several weeks on this power rating, you come in to look at the power rating, you see what looks strong. And over here, you're going to see, okay, here's healthcare, Spider, here's a biotech, Here's IBB. It's up like 30% over the last. Look at these charts on these things. These aren't rolling over. And if you want to, find where some of the bull markets are, I know uranium has been in there for a long time. Believe it or not, this ICLN Clean Energy Index has been going crazy over here. If you compare this to some of the other major averages, they're going sideways, and these things are breaking out some new highs. This would be a place where you oftentimes will find stocks that you're not really thinking about. Most people are looking at Alphabet, they're looking at NVIDIA, they want to get Broadcom, all these kind of things, Palantir. But rather than doing that, if you look at some of these ETFs, they're going to tell you where the money's going. And then you look at some of these 50-day relative strengths. Here's clean energies beating the S&P 500 by 12%. The biotech IBB is beating the S&P 500 by 10%. These are areas where you can maybe nibble away, and they're usually going to be a little bit, not contrarian, but they're going to be different than what you're seeing on the headlines. But technically, MarketEdge looks at these, and we think that they're strong technically. And it may be some places, sometimes it's a utility fund or something like that, or the more conservative plays that you don't know about. Gold and silver were some of the top ETFs here almost all summer. They're just starting to roll over a little bit. So it's something that you might want to look at just to see what sections of the market seem to be outperforming, because it doesn't necessarily mean if we're going to bounce back that the Mag 7 and the big cap technology stocks are going to be leading the market higher over the next couple of months. So this would be a place where you can go in and find some of the changes in leadership that it works out well for me. And I think that you'd be wise to kind of look at that. It would help you diversify some of your holdings in your portfolios.
All right, nice and measured outlook. So, is there anything else you want to share before we head out today?
Like I say, let's kind of watch to see what happens this week, and we'll see if these support levels hold on and see what happens with NVIDIA. Again, a lot of retail stocks coming out, and they may start to say that they're seeing the consumers spending slowing down. And that's also a problem for the market going forward, because right now the consumer has been very strong and holding up a lot of the market. So if they start to tighten their purse strings, that could also be a little bit of a problem for the market going forward.
Great, that'll be it for this week. If you have any questions or feedback, please feel free to leave them in the comments if you're watching on YouTube, or send us an email to support@marketedge.com if you're watching on the website. MarketEdge.com is your source for unbiased technical analysis on over 5,000 stocks and ETFs. So give us a look at MarketEdge.com to see how we can help you find an edge in your trading. Thanks so much for watching, and we'll catch you next week. Thanks, David.
Okay.